Hello, this is Nick Giardina from Mcol, and I would like to welcome our listeners to today's podcast session. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give us his quarterly insights into financial markets and health plans.
Thanks, Nick. In this podcast, we'll review the performance of the managed care industry for the third quarter of 2018 and year-to-date. We'll also discuss sector valuation indicators and operating trends. First, I want to speak to stock prices and valuation. As of the November 9th close, stock prices for the publicly traded health insurers are up by an average of 29% since the beginning of the year. The market benchmark, the S&P 500, is up by 5% during the same period. Health plan market capitalization has increased by 25% year-to-date. Stock prices for 8 of the 9 plans have gained ground year-to-date, led by Medicaid concentrated plans. Molina's stock price increased by 77%, followed by Centene at 42%. Humana was higher by 37%, WellCare by 35%, Anthem by 28%, United Health gained 26%, Aetna increased by 16%, and Cigna moved higher by 9%. Notwithstanding its commitment to Medicaid, S, based in Puerto Rico, was lower by 12%. Positive investor sentiment combined with an 18% growth in net earnings are likely key to this appreciation. Valuation metrics were higher since the beginning of the year, with price to trailing 12 months earnings higher by 14% to 24 times, and price to operating earnings gained 27% to 17 times. Price to sales increased by 21% to 0.86 times, and price per total member gained 24% to a little over $3,000 per member, and price per risk member grew by 33% to around $5,400. All rates of change are calculated holding constant the universe of health plans in both periods. Since our last podcast in August, the average health plan stock prices are higher by 3%, with health plan market capitalization higher by 7%. The S&P fell by 1% since August. Health plan valuation metrics also trended higher. So, on to our review of operating trends. For the third quarter of 2018, combined ASO and risk membership grew by an average of 8%, while increasing by 3% in total to 156% year over year. By average growth, what I mean is the average of each health plan's growth rate. The total increase reflects the change in the combined membership of the plans. Fully insured risk membership increased on average by 6% and in total by 5% to 81 million members. Medicaid plans had an increase in membership by 17% on average to 20 million members. WellCare led Medicaid-focused enrollment gains with an increase of 1.2 million insured members. Commercial plans' fully insured membership did not change on average, but had a 2% total increase to 62 million members. The proportion of members served on a self-funded, that is ASO arrangement, decreased by 1 percentage point to 47.9%. Self-funded members totaled 75 million, which was an increase of 8% on average and up by 1% in total. 2018 third quarter revenues increased for 8 of the 9 plans. Revenues grew by 10% on average and 11% in total to $144 billion during the third quarter. Medicaid plans earned revenues of $26 billion, posting an average and total growth of 15% and 21% respectively. Commercial plans experienced a 7% increase in revenues and a 9% total increase to $118 billion for the quarter. Premium rates for 8 of the 9 plans increased by an average of 5% to $488 per member per month. The average commercial plan experienced a premium rate increase of 8% to $534 per member per month, and Medicaid premiums were flat at $398 per member per month. Now, this premium rate growth does not adjust for changes in product mix or other benefit design changes. For example, the widespread shift in favor of Medicare Advantage likely increased the apparent growth in expenses. As an aside, we'll close this presentation with a brief summary of the results of our 24th annual premium rate increase. Year over year, quarterly operating earnings trended higher for 7 of the 9 plans. For all plans, operating earnings increased by an average and total of 10% to $9 billion. Medicaid operating earnings of $835 million represented an average increase of 14% and a total increase of 10%. Commercial plans reported an average increase of 8.1% and a total increase of 10% to $8 billion. Note these average changes exclude, that is, changes from losses to larger losses. Average operating margins were lower by 0.1 percentage points to 6.6%. Medicaid plans posted a 0.3 percentage point decline to 3.6%, while commercial plans increased by 0.1 percentage points to 8.1%. The health benefit ratio for all plans decreased by 1.6 percentage points to 81%. By the way, we exclude in our calculations the impact of favorable and unfavorable prior reserve adjustments, instead placing those to correct prior period numbers. The average health benefit ratio for the Medicaid plans decreased by 1.6 percentage points to 83.2%, while commercial plans experienced a 1.6 percentage point decline in the health benefit ratio to 79.8%. The average administrative expense ratio increased by 1.3 percentage points to 11.9%. Medicaid plans reported a 1.6 percentage point increase to 13%, while commercial plans posted a 1.2 percentage point increase to 11.4%. Higher administrative costs for plans can be partially attributable to the restoration of the health insurance tax after its temporary suspension for calendar 2017. Non-operating earnings decreased from $616 million to $429 million year over year. Our calculation of non-operating income, of course, equals investment earnings, but it also includes income that is earned in non-health lines of business, but it deducts from that interest expense. Medicaid plans posted non-operating losses of $5 million compared to last year's much larger loss of $33 million. Non-operating earnings for commercial plans decreased from $648 million to $426 million in the most recent quarter. Third quarter net earnings were higher for 7 of the 9 plans. Net earnings decreased on average by 6%, but increased in total by 18% to $7 billion. As with administrative expense trends, the year-over-year comparisons are impacted by the restoration of the health insurance tax for 2018. Now, I want to close by touching on 2 different but related environmental factors. Each year, we poll health plans to determine their premium rate expectations for the following year. This year, we received responses to health plans serving over 20% of Americans covered by fully insured commercial group and non-group products. By insured, I mean literally paying premiums as opposed to ASO arrangements. The health plans are expecting 2019 premium rates to increase by 5.2% for group fully insured plans, while growing by less than that, 4.4% for individual plans. For group plans, this growth is 2 percentage points lower than their expectation for 2018. However, for individual plans, growth expectations are considerably lower, by 16.8 percentage points. The actual increase that the responding companies are expecting is less in both segments due to buy downs. The participants expect then lower gross margins as well, that is, premiums less medical expenses. They anticipate an MLR increase for groups of 0.7 percentage points and a 2.8 percentage point increase for individuals. Since health plans are a thin margin business, the expected decline in gross profits amplifies the need to manage administrative costs to enable you to sustain a competitive advantage. The Sherlock benchmarks are the most efficient way to objectively identify and prioritize high costs. Licensing is immediately available, and we are building panels for 2019. Health plans serving 167 million Americans have used the Sherlock benchmark since 2016. So please contact me if you have any interest in licensing or participation. This is Doug Sherlock of Sherlock Company.
You've been listening to Doug Sherlock share his quarterly insights into the financial markets of health plans.